Welcome to the Wealth Wisdom, where knowledge becomes power and power builds your future.
Most people believe that global finance is fragmented, messy, and unpredictable. They assume countries act independently with their own policies, currencies, and financial rules. They think no single authority could possibly control what happens on a global scale. But that belief is dangerously naive, because beneath the surface, a quiet transition has been unfolding for decades, a shift toward a single global financial authority. And no, this isn't a wild conspiracy theory whispered online. This is a story written in boardrooms, central banks, and international agreements. A story that touches every bank account, every currency, every investment, and ultimately every citizen of the world. You don't see it happening because it's designed to be invisible. It moves in subtle shifts through treaties, trade agreements, financial standards, and digital currency initiatives. By the time the effects reach your life through rising debt, shrinking purchasing power, or the convenience of global digital payments, the transition is already decades ahead. Most people notice only the consequences, never the architects. The origins of this transition trace back to the early 20th century, when the global economy faced crises the world had never seen before. World War I, the collapse of empires, and the Great Depression forced nations to collaborate in ways they had never done before. The old gold standard, which tied currency value to a fixed quantity of gold, proved fragile. Governments needed a system that could flexibly expand or contract money. They needed international cooperation to stabilize trade. It was during these chaotic decades that key figures and institutions began to sketch a vision of global financial governance. Economists, central bankers, and political leaders, people like John Maynard Keynes, the architects of Bretton Woods, and later the creators of the IMF and World Bank, started laying out a system where international finance would be regulated collectively. The promise was stability, predictable exchange rates, coordinated monetary policy, safeguards against another catastrophic depression. But with stability came control. These institutions didn't just coordinate, they standardized. They set rules about who could borrow, how much currency could be issued, and how nations should manage debt. They created tools to enforce compliance, loans tied to policy, reforms, debt restructuring conditions, global accounting standards. Over time, the reach of these institutions expanded far beyond what anyone imagined. The rise of this system followed clear cause and effect patterns. After World War II, the US dollar became the global reserve currency. Nations held dollars as collateral, first tied to gold, and later to trust in US economic and political power. One country, through its currency and central bank, could now exert influence globally. But the architects weren't satisfied with mere influence. They wanted a framework where monetary policy could be synchronized worldwide, minimizing shocks and defaults. International agreements, from Bretton Woods to the General Agreement on Tariffs and Trade, tightened interdependence. Every crisis revealed vulnerabilities in the system, prompting more coordination. The oil shocks of the 1970s forced nations to align monetary policies. Latin America's debt crises in the 1980s brought structural adjustment programs. linking financial assistance to centralized economic planning. Each event reinforced a lesson. Instability anywhere is a threat everywhere, and the solution always involved more oversight, more standardization, and ultimately, more centralized authority. The breaking point never came in a single moment. It emerged gradually, through compounding crises, financial bubbles, hyperinflation, sovereign defaults, and banking collapses exposed the fragility of national-only approaches. Nations increasingly had to surrender aspects of their financial sovereignty to access capital, stabilize currencies, or join trade agreements. Debt restructuring often came with conditions dictated by supranational institutions. Digital financial tools accelerated the dependency, as central banks and international organizations coordinated cross-border payments, monitoring, and compliance systems. The fallout of this gradual surrender is subtle but profound. Citizens are the last to notice, but they feel it everywhere. Rising personal and national debt, standardized regulations, restricted currency autonomy, and economic policies increasingly shaped by international agreements rather than local needs. Meanwhile, institutions like central banks, the IMF, the World Bank, and newer bodies like the Financial Stability Board consolidate even more oversight and coordination. The mechanisms designed to stabilize the system now create dependencies that push nations closer to a single authority. Attempts to resist or fix the system have largely failed. National policies, political protests, isolated financial reforms, most are absorbed into the larger structure. When countries try independent currency policies or diverge from global standards, they face market pressures, capital flight, or punitive financial conditions. The more nations resist, the more sophisticated the coordination becomes. Now, with digital currencies on the horizon, including central bank digital currencies designed to operate across borders, the transition toward a unified authority is accelerating. Modern parallels are striking. Global debt has reached unprecedented levels. Every major economy is interconnected through trade, credit, and financial derivatives. A crisis in one nation reverberates instantly worldwide. Inflation, interest rate changes, and monetary policy adjustments in one country ripple across continents. In many ways, the infrastructure for a single global financial authority already exists. Standardized regulations, harmonized accounting, coordinated monetary interventions, and digital payment systems. Each agreement, each technological innovation, each crisis nudges the system further towards centralization. The numbers are staggering. Over 60% of global GDP is linked to institutions and mechanisms that operate internationally. Sovereign debt restructuring increasingly comes with IMF conditions. Cross-border digital transactions are projected to explode in coming years, with oversight standards being developed globally. Central banks have created mechanisms for coordinated emergency lending, ensuring financial lifelines are dictated collectively. Even cryptocurrency adoption trends toward platforms monitored by international standards, mirroring the trajectory toward central oversight. So what can we take away from all this? First, financial sovereignty is becoming increasingly complex and constrained. Decisions made on a global, level impact local economies in ways most citizens barely perceive. Second, the system is designed for stability, but stability comes at a price. Reduced individual and naughty owner. Control over money. Third, awareness is your most powerful tool. Understanding how interconnected finance has become helps you navigate the risks and opportunities. In a world moving towards centralization, the warning is subtle but urgent. The quiet shift toward a single global financial authority is accelerating. The mechanisms exist. The precedent is set. Technology will only make it easier to monitor, coordinate, and enforce financial rules globally. Every citizen, investor, and business leader needs to understand these shifts because the consequences of ignorance are real and tangible. And the final thought, global finance is changing beneath our feet. Decisions made decades ago, agreements signed quietly, technologies deployed incrementally, crises managed step by step. They're shaping a world where money, credit, and financial opportunity may increasingly depend on a centralized authority. Awareness, critical thinking, and vigilance are your first tools to navigate this transition. The second tool is action. Stay informed, diversify risk, and participate in discussions about monetary policy and digital finance. If this exploration has opened your eyes to the forces quietly shaping global finance, subscribe and stay connected. Each week, we uncover the hidden mechanisms of money, power, and policy so you can understand the currents before they reach your life. Knowledge is no longer optional. It is your first asset in a world quietly moving towards centralization.